This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Good evening, everyone, and welcome to this special edition of Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Matheson. Welcome from me as well. Well, summer is here and the temperatures outside are heating up, and if you're lucky, so are your investment returns. With the first half of the year now in the books, tonight we take a look at what might be in store for the second half, from stocks to the economy, even drilling down into autos and airlines.
So we begin tonight with the stock market, which was relatively calm in the first 6 months of the year. But in that calm, equities climbed a lot, pushing the major indexes into record territory numerous times. But what happens next? Dominic Chu tries to answer that question.
Not everyone believed it could actually happen, but a slow and steady move higher by the stock market has us still near record highs. A lot of traders think the positive momentum can continue into the second half of the year.
History shows that when the first half of the year is as good as it is, the overwhelming majority of the time, the second half of the year continues higher.
Recent history seems to validate that storyline. According to market data and research firm Kensho, since 1980, during the first year of a presidential term, the S&P 500 is generally positive during the third quarter. And it has actually not had a losing fourth quarter during those time frames either. There is one sector in particular that many traders are keeping a very close eye on to set the tone for the rest of the year.
The most important sector, and it was last year as well, is the financials.
Financials will be the sector to watch.
If you can get the financials working back in, particularly if there's a hint of deregulation, I think then the whole market will pull together and we can see new highs.
And there's one item on the Washington agenda that has all of Wall Street totally captivated.
Tax reform. If we can get tax reform, real legitimate tax reform through, then that's a real positive. If we can't, that's a real negative.
I think the most important thing in the markets will be how the tax packages go through Congress.
Tax reform, without question.
So far this year, there's been a noticeable absence of any kind of stock market volatility. While that could continue, there are those who believe that bigger swings in the market are coming soon.
One of the most notable themes of the first half of 2017 has been the lack of volatility. The VIX index, which many people look at as a measure of volatility, has been extraordinarily low. We would expect that to change in the second half of the year as people begin to realize economic realities are not what they hoped they would be.
Since the election, and arguably beyond, the stock market has rewarded buy and hold investors with higher prices and lower volatility. But Wall Street experts aren't letting their guard down, and they're putting earnings, economic data, and the Fed under the microscope. For Nightly Business Report, I'm Dominic Chu.
Well, when it comes to the economy, growth is meandering along, but a few events in the months ahead could shake things up. Steve Leisman explains.
In the second half of 2017, September will stand out as the month to remember when it comes to the economy. That's when the administration promises to deliver its sweeping tax plan, when the U.S. might hit its debt limit, and when the Federal Reserve could begin reducing its $4.5 trillion balance sheet. Most important, by the end of the summer, we should have a better fix on three critical economic gauges. First, growth. The U.S. started the year with lackluster GDP of just 1.2%. That looks to have accelerated in the second quarter to near 3%. By September, we should know if all that post-election enthusiasm by consumers and businesses has turned into post-election sales at the mall and investment from companies. So far, the results are mixed. Second, the unemployment rate. It's fallen to a 16-year low of 4.3%, and many economists say this is full employment. But it may have further to run, especially if growth picks up. But if the rate goes too low, the Fed could begin worrying about the third big item on the list. That's inflation, or the lack of it. It's been moving away from the Fed's 2% target for the past 3 months, dragged down by lower oil prices and a decline in telecommunication costs. Fed officials say they expect inflation to pick up in the months ahead, but some are starting to get nervous. If inflation doesn't pick up, that will likely put the kibosh on a third interest rate hike this year from the central bank. The best guess? Growth in the next couple of months will look a lot like it did in the first half of the year. Despite ups and downs in GDP, it's likely to average right around 2%. Any impact from fiscal policies out of Washington, that's a story for next year, not this one. For Nightly Business Report, I'm Steve Leisman.
So let's turn now to our two guests for their outlook for the economy and the financial markets in the second half of the year. We have Josh Feinman, Global Chief Economist at Deutsche Asset Management, and Tom Stringfellow, President and Chief Investment Officer with Frost Investment Advisors. Welcome to you all. Josh, I'm going to start with you. It looks as though things have steadied out in the economy. We're seeing some pretty steady growth. How does the second half look to you?
I think the economy is starting the second half with pretty good momentum. It looks to be in good shape. Much of the cyclical repair has been done. The labor market is largely healed, and I think it will get to the line, if not a little bit over, by the end of the year in terms of full employment. I think the fundamentals still look pretty good to continue moderate growth. The question, of course, or the issue is structurally potential growth in the economy is diminished. And that's not something that lends itself to quick or easy solution. But from a cyclical perspective, I like the economy. I think it's likely going to continue.
So, Tom, what are you looking for in the markets in the second half of the year? It's been a pretty good first half, not just in the U.S., but globally.
Yeah.
Is it likely to continue? What should I be watching out for?
I would agree. I think it's going to continue. Everything that Josh had mentioned about the economy does play into the markets. You know, there are some concerns. We've had concerns this first half of the year, last year. A number of sectors that can't seem to get traction or maintain traction. I think that does continue into the second half of the year and going into probably 2018. There's a number of sectors that I think are very positive. But, this is going to be
like what? Give me a couple of names.
I would say financials will be positive in through next year.
Good news from the banks last week. Yeah.
Absolutely. Technology, I think, continues to be a positive. Healthcare, and healthcare, especially healthcare technology, I think continues to be positive.
All right, Josh, you say that there are some pitfalls, though, to watch for in the second half of 2017 and maybe the beginning of 2018. What would they be?
Well, I was saying some of the structural forces, the trend, we're living in a slower growth world. I think that's still going to be with us. The issue was raised earlier on the program about the policies coming out of Washington. A lot of people are banking on tax reform. I think we're going to get something, but of course there's a risk that that falters. I think that's a potential downside to watch. And then the inflation question. Inflation has surprised on the downside. I think it is largely reflecting transitory factors, but we're going to need to see inflation move, up a little bit further for the Fed to continue on this gradual path of raising interest rates.
So, Tom, let me hit you with a double question here. One is domestic oriented, and that is how concerned are you about the value of stock prices right now? Are they a little stretched, a lot stretched, or roughly where they ought to be? And number two, is the U.S. a better place to invest now for the second half of the year, or should I look overseas?
Good questions and spot on. I'd say the stock market is a little stretched these days. For it to continue, we've got to have obvious earnings growth. If we can stay in a kind of a low inflationary environment, investors will love that. Not fixed income investors, but equity investors will appreciate that. I think the dynamics between the U.S. markets are really interesting. It's going to be dependent on, the strength of the dollar, where investors want to move. Do they want to come back to the U.S.? But if you look at some of the multiples, the foreign markets are a little more attractive these days.
Josh, you get the final word. Where would you be putting money to work right now?
I think that with the economic cycle still having further to run, I still think risk assets, equities, credit product still look good. Although I agree, we are getting a little bit stretched in valuations, and some of that is predicated on us getting tax reform done.
All right, gentlemen, thank you. Josh Feinman, Tom Stringfellow, thank you both for joining us today.
Thank you.
Thank you.
Well, the best performing sector so far this year has been, you guessed it, technology. The S&P Tech Sector ETF up double digits so far. Stocks like, some of these names, Facebook, Amazon, Netflix, Apple led the charge, all gaining about 20% or more. A recent CNBC survey showed that half of Wall Street strategists surveyed believe the sector will outperform in the next 6 months, just as our guest Tom said. And in just a few minutes, we'll ask some money managers for their top tech pick for the second half of the year.
Well, 2017 could be remembered as the year of the retail wreck. The sector has been a mess. Sales are mostly weak and stores are closing. But will the rest of the year be more of the same? Courtney Reagan has more.
The second half of the year is always the most important for retail, and this year the sector has a lot of ground to make up. Believe it or not, back-to-school inventory is hitting store shelves in the next couple weeks. That is, if it's not already out. Back-to-school sales follow spending patterns, with every other year marking a time when everything has to be bought, from electronics to pencils, followed by a year of lower spending on longer-lasting back-to-school items like computers and backpacks. Since last year was a big spending year, look for back-to-school sales to be below last year's levels. There are also a few companies to watch. If no other bidders emerge for Whole Foods, a major retail focal point will be how Amazon's ownership influences the organic grocer's potential online grocery business. Some analysts are expecting nearly immediate changes and ripple effects through retail. But Amazon isn't the only behemoth shaking up its purchasing history. Walmart's been on an e-commerce shopping spree, buying 4 e-commerce-only companies, and there could potentially be even more. Macy's is one retailer that needs a reboot and a reboost. Later this year, CEO Jeff Gennett is going to launch a new loyalty program and is expanding the number of Macy's outlets within existing stores, which have been lifting sales measurably, something Macy's needs. The holiday season is make or break for retail, and this year the stakes are even higher. It's the last chance for underperforming stores and brands to prove their worth before decisions are made about which stores will close. And 2017 is already on a record pace. For Nightly Business Report, I'm Courtney Reagan.
Still ahead, portfolio managers with a hot hand tell us which stocks they think will sizzle this summer and beyond. A big theme for the stock market in the first half of the year was Washington. And as John Harwood reports, it will be a big theme for investors in the second half as well.
The first half of 2017 has produced plenty of action for the new Trump administration in courts, at the FBI, on cable television. What it hasn't yet produced is the kind of action that Americans in general and Wall Street in particular most want to see. Concrete action on major priorities like improving health care, reforming the tax system, upgrading the nation's infrastructure, avoiding a debt crisis by passing an increase in the federal debt limit. Rallying supporters in Iowa the other day, President Trump had some high hopes for the second half.
The taxes are coming along and the health care is coming along. And we have Gary Cohn, the president of Goldman Sachs, who left Goldman Sachs on a slightly higher salary than he's getting right now. Where's Gary? He's around here someplace, and Gary's working on some incredible plans, not only taxes, but we're going to be rebuilding our country. We're going to do things in terms of infrastructure that we need.
But can the president and a Republican Congress actually deliver? It's possible. The House has already passed a health care bill, and Speaker Paul Ryan is eager to take up tax reform next. But Trump's infrastructure plan, relying on tax breaks, will have trouble drawing the Democratic support the president needs. Nor will tax reform be easy because of disagreements within the Republican Party. Congress can't even get to tax reform until lawmakers pass a new budget. Budget is also critical to avoiding a government shutdown and raising that debt limit. Hanging over everything is Robert Mueller's special counsel investigation. And if you think that makes the entire second half of the year a giant question mark, you're right. For Nightly Business Report, I'm John Harwood in Washington.
Some of the most powerful executives in corporate America are the chief financial officers. They make the most important money decisions, like what to invest in and when to hire. So Jackie DeAngelis conducted a survey recently to see what the C-suite expects in the months ahead.
What's keeping CFOs up at night? Their biggest external risk factors are consumer demand, cyber attacks, and U.S. trade policy, in that order. With respect to trade policy, there's some concern that the president's recent rhetoric towards Germany could lead to a trade war with that country or the entire EU. Just under 60% of respondents said that they're somewhat concerned about both. Regarding the global economy, the Eurozone, which CFOs said for the last 3 quarters was stable, was actually upgraded to improving, while the U.S. held on to the improving title for the 4th straight quarter. We also asked about the stock market. Would the Dow see 22,000 before it falls back below 20K? 60% said yes, we'll go up before we come down. Interesting where they think the market's strength is going to come from. Roughly 40% said technology will drive the market. That was up from 20% last quarter. Financials, which was where they were placing their bets last quarter, dropped to 2nd place, but 15% still think banks will be a bright spot. When asked how they think the Fed will act for the remainder of the year, a little more than half said that we got our 2 rate hikes and we won't see any more this year. Finally, on President Trump, they're more pessimistic that he can pass key legislation in 2017. Probability of passing dropped in every crucial category. Overall, an optimistic but cautious tone. For Nightly Business Report, I'm Jackie DeAngelis.
With equities on a tear, we've got 2 of our top market monitors to join us now to talk about tech, financials, healthcare, the sectors and names they think will perform well in the second half of the year and beyond. Marianne Montaigne is a portfolio manager with Gradient Investments, and Gary Bradshaw is a portfolio manager at Hodges Capital. Welcome to both of you, or I should say welcome back. We're going to take a look first at your tech picks, both of you. I'm going to begin with you, Gary, because you have 2 choices in that sector, little companies that neither of us have ever heard of. One named Microsoft. Explain to me what they do. And then this newfangled one called Facebook. Why do you like them both?
Well, Tyler, with Microsoft, they've got the wind at their back, and it's because of cloud computing. And it's not just the cloud business that's reinvigorated Microsoft, but Windows 10 is doing well. Bing is doing good, their search engine. And because of their businesses, Xbox and all, their earnings are reaccelerating. So we like Microsoft in here. It pays a nice 2+% dividend. It doesn't hurt that they have over $100 billion of cash in the bank that allows them to buy in stock.
A little more than I've got. Facebook, quick thought on Facebook. Give us your thumbnail on it.
Tyler, we think Facebook is cheap. And with 1.9 billion active monthly users, their advertising business continues to accelerate. We think they'll earn $6 next year. They're growing revenues and earnings 40+%. Put a 30 multiple on that $6 and you come up with a $180 stock. So we think it's cheap in this market that we think will continue to be good.
All right, Marianne, let me turn to you. You like Nutanix. Recently, it had a big gain because of a deal that it inked with Google. Why do you like the stock?
Right. Well, this is a pure play data analytics, cloud computing enabling software company, and that's a whole mouthful. But what it does is it offers companies the ability to have all of their software talk to each other, all the other components, and then send it out to the cloud, whether that's private or public cloud. So this is a company that's growing the top line at a better than 50% rate. And we think that the valuation on a price-to-sales basis is about a 30% discount to its peers. And as you said, with this new partnership with Google, we think the valuation will probably go toward the peer average.
All right, let's transition to a couple of picks that you have in healthcare. Gary, you have 1. Marianne, you have 2, one of which is a biotech ETF. Let's go to Merck first, Gary. Why do you like it?
You know, Tyler, Merck has a new drug, Keytruda, which is a cancer drug, and sales are really ramping up. We think they could do $10 billion off of Keytruda by 2020. It's got a great dividend of 2.88%. Earnings are accelerated, 17 times earnings. We think Merck is a Cadillac healthcare stock to own.
And Marianne, you have 2, as Tyler mentioned, Alexion Pharmaceuticals, and then the iShares Biotech ETF, which is IBB. Let's start with Alexion.
Yes, Alexion has really primarily one drug, and it's for eye diseases, rare eye diseases. But they have a nice pipeline, and we think it will play out very nicely over the next year or so. Someone else believes they have a great pipeline, too, and that's the CFO who's coming over from Biogen, which is a much larger biotech play. So we think this is a real neat, sweet situation here. Also growing extremely fast, and we think there's a lot of upside to this one, at least 20% upside. In terms of the IBB or the iShares Biotech ETF, that's a way to be invested in about 150 different companies, both biotech and major pharmaceuticals, and reduce your risk, have lower volatility, because a lot of these companies do depend on those, one-time decisions from the FDA on safety and effectiveness.
We're a little short on time, Gary. I'm going to give you a pass on making a selection in the financials, but Marianne, you like J.P. Morgan Chase, the banks last week getting nice news out of the Fed. You really like this one.
Yeah, again, with the increase, as you say, from the Fed, the permission to go ahead and both boost their dividend, which they did by 12%, and also buy back shares, another form of returning capital to shareholders. That's going to be about 6% fewer shares outstanding, so we can see at least 10% upside.
All right, folks, thanks very much. Marianne Montaigne with Gradient Investments, Gary Bradshaw with Hodges Capital.
Coming up, the Hyperloop personal flying machines. They may sound far out, but you'll likely hear much more about them in the second half.
Heading into the second half of this year, the world of transportation will see several big developments, from how we move in a car to planes and perhaps even how we move in a tube. Phil LeBeau explains.
Tesla CEO Elon Musk will be in the spotlight in the second half of this year as the automaker makes several big moves. One will include dramatically ramping up production at the company's plant in Fremont, California, as Tesla launches the Model 3. Starting in the mid-$30,000 range, the Model 3 is aimed squarely at the mass market. Tesla is also expected to announce plans to expand in China with a final assembly plant, a huge move since China is the world's largest auto market, and the Chinese government is aggressively pushing adoption of electric vehicles. In the airline industry, the big question is what impact enhanced security screening will have on approximately 2,000 international flights landing in the U.S. every day. There's speculation tighter security could hurt the airlines because some customers might put off long international trips due to the inconvenience and potential for more restrictions that could be put in place later this summer.
I think we would find a way to put up with it because we're traveling for reasons.
Finally, the Hyperloop is expected to take a big step closer to becoming reality. After months of working on the technology in the desert outside Las Vegas, Hyperloop One is planning a full-scale test run in tubes covering roughly a third of a mile.
We're at least two-thirds the cost of high-speed rail. We need much less land, and we can go both above ground or underground to come into city centers.
The Hyperloop is just one of the budding forms of transportation you'll hear more about over the next 6 months. Here's another, personal flying machines. Imagine something that combines the technology of helicopters and drones, but is flown by a person at a low altitude. The first of these personal flying machines could be sold to a paying customer by the end of this year. Phil LeBeau, Nightly Business Report, Chicago.
From the Hyperloop to the Great Space Race, investors should expect some new developments and new innovations in the second half, and Morgan Brennan has more.
It's been a stellar year for space advances. Jeff Bezos unveiled the Blue Origin capsule that will carry paying tourists past the edge of space. And Elon Musk's SpaceX successfully launched 2 different reused rockets. But the biggest milestones are yet to come.
Their big milestone, I guess, is the first launch of their new rocket, the Falcon Heavy, which is 3 Falcon 9s kind of kludged together.
That SpaceX launch will usher in an era of more powerful rockets. The first step in a broader industry effort to eventually take humans to the moon and then to Mars. A next-gen rocket is also in the works from Bezos, but the engines for that one may first reach space with a rival, United Launch Alliance, which is hoping to use them on its new Vulcan, replacing Russian ones that irked Congress for years. Blue Origin will even move production to Huntsville, Rocket City, Alabama, breaking ground on a new facility in coming months. But it's not just rocket science. Brace for massive constellations of satellites. Startup OneWeb is building its first factory to mass-produce mini satellites for broadband use, and SpaceX will soon test its own offering as well. All of this as lawmakers now look to reorganize the way the government manages all of this orbital activity.
We just saw Congress, the authorization subcommittee in Congress vote to create a space corps within the Air Force that would kind of operate as like an autonomous part of the Air Force, kind of the way the Marine Corps does in the Navy.
But first, there need to be some new hires, especially on the civil side.
One of the things we all are waiting for is President Trump to name a new head of NASA, to activate the National Space Council with the Vice President as its head, and then set out some sort of his vision for what the civil space program is going to be.
For Nightly Business Report, I'm Morgan Brennan.
I'm not sure if I'm ready for personal flying machines.
Or that
or
Hyperloop, the tube. I'm not sure I'm going to get in one of those tubes.
We'll let other people do it first. Thanks for watching this special edition of Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Matheson. Thanks for watching. Have a great evening and holiday, everyone. We'll see you tomorrow.